Hi, welcome to this trading strategy workshop with me, Jan Motak, Chief Market Analyst for TIO Markets. And in this webinar, I'm going to give you some ideas on how to develop your own trading strategies, because obviously you can't copy somebody else's strategy if you haven't got the sort of deep understanding what's under the hood. You need to understand how the strategy works, what are the weaknesses, what are the strengths. And when you have studied things thoroughly and you understand what different options there are, what are the weaknesses and the strengths of these different options, then obviously this helps you to understand how your strategy is, how reliable it is, how it's going to behave in different circumstances. Just a quick reminder that you should go to tiomarkets.com/analysis if you want to have quality analysis on daily basis. We are hitting the targets quite often, so I'm sure you find it useful. And this is basically the feedback that we are getting from others, so I think you will like it also. And this is highly important. We don't provide any investment advice. You should only watch this video and you should only read our material if you agree with this disclaimer saying that we only provide you with educational material. Here's my background briefly, so I'm not going to take too much time with it. Just to say that I have been in the business since 1998, both in the institutional side and retail side, so I can give you what I've learned over the years, and I'm sure it's helpful. At least clients are saying that at the moment, so I'm sure you will benefit from what I've learned over the years, and it will speed up your own learning curve. In my current role, I'm the Chief Market Analyst, and I'm responsible for market analysis and trader education. In the last webinar, we covered trade types, market timing tools, and how to trade around the US elections. And now in this webinar, we're going to cover the options on how to place stops and targets, then position sizing, and how to use indicators to create trading strategies. First of all, when you are placing stops, it's good to know that it's very, very difficult. It's difficult for even people who are professionals in the business, because it's very difficult to find a sort of stop level that is optimal, or the distance from the entry that works in most cases. So expect this topic to be challenging, especially when you start applying it, but I'm going to give you these 4 options and I'm going to explain them briefly so that you can go and study the price action, go to price history and see what works, and most importantly, what suits your personality. Some people like fixed distance stops. So say you are buying at X price and you place the stop 30 pips or 60 pips below. So this method has its sort of good sides, its benefits and its weaknesses. The weaknesses include that if your stops are too close, you get stopped out too often. Even though it feels very safe to use 10 pip stops, then I'd say try to avoid that, because unless your market timing is very, very, very good, it's easy for the markets to just move 10 pips and take you out and then move in your anticipated direction. That is so frustrating. That is something you don't want to live through. So it's better to have something else than just fixed distance stops. Obviously, the other option is to have 100 pip stops or 80 pips, 70 pip stops. But then, even though the market doesn't come to those levels very often, and doesn't stop you out too often, then when it does, and when it happens in sort of several occasions in a row, then it's more, the losses over that losing period are going to be maybe bigger than you want them to be. So you need to find something that fits to what you see in price action at the moment. Then I think a step to the sort of right direction is to have a fixed distance beyond your recent low or high in the price data. So if you are a buyer, you obviously want to place your stop below a recent low, because that's where the buyers came in the last time, that's where the support is, so it's sort of less likely for the market to move there again. Now, how much is that distance between your recent low and the stop price? That's obviously then going to be the difficult question. And if you widen the stop and keep your position size constant, then it means that you are increasing the risk, and that might not actually be advisable. So let's study what can we do here. And the two methods that I'm going to use a little bit of time on and have examples are price action oriented method and ATR multiplier method. They both are practically based on the recent volatility. And obviously then we have the question on how much of the recent data we should include, but maybe what I'm going to show you gives you some answers. So price action oriented method first. Okay, here we have pound USD in 30-minute time frame. The market is trending lower, as you can see from the 50 period moving average. It's pointing lower. The price is mainly moving below the 50, and there are occasional rallies and spikes above the 50 period moving average. But most of the time it's down here. So the market is trending lower. The old adage is sell rallies in a downtrend and buy dips in an uptrend. So we want to be sellers, and here's one strategy for you. You want to be a seller when you have the market moving lower and you get a signal, and I'm going to show you a stochastic signal here in a moment. So in this situation, the market starts to rally against the trend. It moves higher and higher and higher. And then you can see how the oscillator, the stochastics oscillator, and I think I have 5, 3 and 3 values here, as I usually have. Yes, I like the settings because it's quite responsive. So the market rallies so that the oscillator moves above the 80 level. And then we get a close down so that the oscillator, the blue line, crosses below the red line and we have a sell signal. Now the question is where to place the stop so that if the price spikes again higher, then where might it, we don't want to be stopped out and then have the market moving in our direction again. Obviously we want to keep this short position as long as it makes money, and we don't want to be stopped out too early. So the method I'm suggesting that you study is that you take the recent price range, and there's a good nice little tool here in TradingView for this. So you take the recent low and the recent high and you measure it. That's about 80 pips roughly. So obviously we could use all of the 80 pips above the most recent high, which would be quite far, and basically it would mean we have too much risk and it wouldn't make any sense. Or alternatively, the position would be quite small. and I'll explain you later why. But most of all, it's just the bottom line is it's too far. So what I'm proposing here is that based on the recent price range, you decide to take portion of it. Let's say that just for simplicity's sake, we take half of it. So let's say about 40 pips, about 42 pips. That's there we are. Okay, it's 43 now, but it doesn't really matter. So, and then we project that above this most recent high, because this is the current moment at the time of this setup. So market is at 30.50 and we place the stop, for instance, above 40 pips above or 43 pips above the recent high. It's very generous and very wide stop. But then the market moves and moves in our direction. So now we have the option of obviously either tightening the stop or keeping it where it is. We have some other options like buying back some of the position. I like to use the target one often. If I'm selling in a downtrend, I like to have the target one fairly close to the recent lows so that I get some money out of the trade quickly. Because the market often rallies from these recent support levels. But I don't want to throw away all of the position just in case the market moves further. Okay, now the question is, did we actually manage to place the stop so that it is not too close to our entry level? If the market rallies, is it going to rally so high that it goes into our stop? In this occasion, the market didn't move there. It just peaked above that 30.75 into 30.80, so about 5 pips, and then started to move lower again. So obviously the question for you is, for you to study is how big of a portion of the recent price move you should project above the recent high. So if you want to have a decent stop size, maybe you want to use 30% or 50% of that range, and if you find that 20% works for you most of the time, then that's fine, obviously. But these are ideas for you to study. So I'm not trying to give you ready-made answers. I'm trying to challenge your own thinking and your eagerness to study. I trust that you, if you are serious about trading, you are serious about studying the market as well. Okay, the next method I promised to talk to you about is ATR method. So instead of using the recent price range based on our own sort of consideration, let's use an indicator called average true range, or ATR as it's also known. Without going into the details on how ATR works, it basically is studying the same thing or indicating the same thing that we studied here. So it gives you the recent range based on some calculations, some math that we just don't have to go into now. But ATR is based on certain look back period. Here we are using 14 period, which seems to be the standard. And just to give you a flavor how it changes if we go to 20, not much really. So the actual value doesn't make that big of a difference. It doesn't make a big difference, excuse me. So now if the short entry happens on this candle where we have the blue line crossing below the red line, then we using the ATR method, we go to ATR and check the ATR value on the same candle, and it's 17 pips. So instead of adding 43 pips, we add 17 pips above the latest high. And in this occasion, it would have been more than enough. So these are the two methods that I would prefer that you would study and see how they work, and please send me feedback. You can send an email to support@tiomarkets.com and tell me how you find these methods working. And then obviously we might want to use ATR multipliers. So basically here we used a multiplier of 1. We just added the 17 pips up here. But you might want to see that in your studies that it's actually better to have ATR multiplied by 1.5 or by 2, which obviously in this situation would mean that you would use a 34 pip stop instead of 17. So these are the methods here, and let's move on. So just briefly, fixed distance from the entry, you have X number of pips behind your entry, and then the question is, how big should the X be? Is it 20, 50 or 80? And this is totally arbitrary, and I think you would need a system that is actually giving you something that relates to the recent price action. Okay, so the fixed distance beyond recent low or high. So when you are shorting, you want to have your stop X number of pips above a recent high. And when you're going the long, you want to have the stop X number of pips below a recent low. Now we obviously have, again, the question, how big should the X be? And unless we derive this number from the recent price activity, we just have an arbitrary number that we really don't know if it's going to work or not. We have to go and look at the history and see what works, and I think that the recent volatility should be taken into account. Okay, now the price action oriented method actually does take the price action, the current or the most recent price action into account. So when you're going long, you want to have the stop placed at recent low minus X period price range times Y. And it could be, the X could be like 20 or 40 or what, I think 20 or 40 should work fine. And then you multiply that by something, represented by Y here. And then the same going short, you have the recent high and you add X period price range multiplied by Y. It could be 0.5, it could be 0.3, it could be 1, depending on your studies and experience. So I encourage you to go and study this. And then the other method that takes the volatility into account is the ATR multiplier method, where you have the recent low, when going long, you have the recent low minus X times ATR as your stop level. So take the recent low and subtract the ATR multiplied by X. And when you're shorting, you obviously want to have your stops above the recent high, but how much is the question, and this method gives you an answer. Because you can take a multiplier of ATR, whether it is 1 or 2 or 3 or 0.5, that's up to you to study, and you add this multiplied ATR value to the recent high. With the idea, obviously, that the distance isn't too far or too big, but the stop isn't too close either, so that you stay in the trade in case the market whipsaws a little more. Okay, then the question of how to place targets, where to place targets. And again, there is no simple answer, there is no one correct answer. It all depends on the strategy that you are using. Do you have one target or two targets? Do you add to your positions? Do you, first of all, scale into your positions? And where do you buy? Where's your cost basis? Or where do you sell to enter into a trade? So all of these questions obviously impact where the targets should be. How far your stops are from your entries, and what's your success rate. All of these things have an impact. So very quickly, 3 methods. You can have a risk multiplier where if your risk is X, you decide that you need to have at least 2 times your risk, 2 times your X as profits when the market moves to your target. So you might want to have 2-to-1 reward to risk ratio. Then the other option is to use an ATR multiplier again that takes the recent relevant price action into the calculations. So you might want to have ATR multiplied by 3 or 4 when you plan your target levels. Or lastly, you can go to higher resolution and see where you have some significant levels that price could turn from. So obviously if you have a resistance or if you have a support, then and they are in higher time frame, then there's increased likelihood that the market reacts to those levels. So these are the methods: risk multiplier, ATR multiplier, where you add certain multipliers into your entry price when you are going long. Obviously your targets are above your entry price when you're going long, and when you're going short, your targets are below your entry price, and then there you subtract these multipliers from your entry levels. We are going to spend a little more time and go more deeply into placing targets in future webinars, but in order to save time, we're going to move on now so that we get to other important material also. One of the most important, some people I think might be arguing that this is the most important question when building a trading strategy, and that is position sizing. So there's 2 options basically. You can either have a fixed trade size. Some people want to use 1 lot, 2 lots, 3 lots, depending on their account really and their sort of risk tolerance. Account size and their risk tolerance. But this leads to variation in risk, which isn't great, because if you have sort of fixed trade size and then you vary your stop size, sometimes you have 20 pip stop, sometimes you have 60 or 80 pip stop, and you always have 2 lots per trade, then it means that sometimes you lose more, sometimes you lose less. Unless this is part of your strategy and by design, I would advise against it, because there is another method that helps you to keep your risk fixed at 2% per trade, for instance. This means that your position size will vary and your rewards from the market will vary, but in the long run, I think it's better that you always know that you never risk more than 2% or 1% or 0.5%. It is more, I find it so much better for my psychology if I can have some, if I can predict based on the risk that I take. If I know that my success rate is 56% or 67%, whatever. It varies obviously over time. But then I knew that because my risk is never more than 2% per trade or X% per day, then I know that there is positive expectancy in what I do. But if you sometimes lose 5%, sometimes 15%, sometimes 20%, and sometimes only 2%, it means that you don't know exactly what's going to happen. You don't have any idea. Obviously, we never know exactly what's going to happen, but you really don't have any idea what's going on with your trading. That's why I would suggest let's keep the risk at 2% per trade. And how do we do that? Let me show you. Okay, I'm going to use a spreadsheet here that I have created for you. The values here obviously are going to be different to what you have on your trading account. I'm just using these values because everything is simple when we have a 100k account size. So we are assuming 100k on our trading account, and we're not risking more than 1%, which equals this obviously 1% of 100,000. And with Euro USD we have a pip value of 10, and here we have the trade entry price, stop loss price and target price. All of these are without the number 1, because it's, it would be 1 spot 1750, 1 spot 1725, 1 spot 1835, but because that 1 is just dormant number, we don't use it here. I'm basically there's these green fields here represent just cells where I can input values and not change anything in the calculations, in the formulas. So how does it work? First of all we define how much money we have on the account. We have 100k, and then we say that we're not going to risk more than 1% in this trade. But because the difference between the entry price and the stop loss price differs, it differs based on what kind of market situation you have. If you have lots of volatility, you have to place the stops further away using the ATR method, for instance. And therefore, if the 25 pip stop isn't going to be enough, if our ATR method is indicating that we have to take the stop to, let's say, 1697, for instance, then we have a 53 pip stop, and that should impact the amount of contracts that we can buy. Okay, just to show you, here we had 4 contracts, and then we double the stop loss size in terms of pips from 25 to 53. This spreadsheet gives you 2 contracts of maximum position size. And that's when you have 100k on your account and you're only risking 1%. If you decide to risk 2%, then obviously this goes up to 4. So how can you create a calculator like this? First of all, you can just calculate the difference between the trade entry price and stop loss price. And I'm using absolute values here so that I don't have to worry about negative values. So this is equals ABS and then in brackets E2 minus E3. So we are subtracting from the stop loss from the entry price. So entry price 1750 minus 1697, the stop loss. And that gives us the difference, which is 53 pips in this case. Now then the target price, actually let's not go there yet. But the risk in this case is obviously the difference between the trade entry price and stop loss price multiplied by the pip value. And we know that in Euro USD it is $10. Obviously, if you're trading gold or silver or say S&P 500 CFD, index CFD, you need to check what the index values are, what the pip values are there, and then use appropriate values. But this is how this works. This gives you the risk per contract, and then the maximum number of contracts is this here. The risk per trade, $2,000 divided by the risk per contract, and this gives you the maximum number of contracts. Now then, the target price, why is it interesting? Why should we bother with it? Because the reason is because if we take the absolute value of the target price minus the entry, i.e. the difference between the target and the entry multiplied by the pip value, that gives you the potential in this trade per contract. So that's $850. And then the potential per this position is going to be obviously the number of contracts multiplied by the potential per contract, and that is $3,208. Now, reward to risk simply is a calculation where you divide the potential by the risk per contract. So potential per contract divided by risk per contract. And this, in this occasion, with the entry of 1750, stop loss at 1697 and target at 1835, your reward to risk is 1.6. And if you want to have a better reward to risk, you want to have, say, trade entry. So if you have decided that the stop loss of 1697 makes sense, then you can say that, okay, I'm not going to be a buyer before the market goes to 1730. And that brings the reward to risk to 3.2, roughly 3.2. Or alternatively, if you want to keep your entry, you believe that market's not going to trade lower, you have to get into this trade at 1750. And you're very, very bullish about the market, then you might say, okay, 1715 is my stop, and this increases your reward to risk to 2.4. So by watching this video, you can build this calculator for yourself, and you can always have your risk at 2%. Except when the market moves really fast and there's slippage. Obviously, sometimes market just moves beyond your stop levels without anybody being there to take the other side of your trade. And then you might have a situation where the market gaps beyond your stop and you have a bigger loss than usually. So if you think that you cannot tolerate a stop loss of, even in these extreme occasions, you never ever want to have a bigger loss than, say, 3%, then I would say, okay, let's keep your risk per trade at 1.5. So you never risk more than 1,500 with this account size. So even if the market gaps beyond your level, it's not very likely to go sort of double your loss there if the market conditions are normal. So this is how you can make sure under normal circumstances, the market usually never goes beyond your risk limits. Okay, let's then go back to the charts and see what we can use, what kind of ideas we can bring in to decide when to buy or sell. What kind of technical factors or indicators might go into what we have how we're going to trade. So basically, we have studied already something that is quite promising if we look into it again. And I'm going to show you the charts here. Just a moment, I'll bring it up. So here I have pound USD in 30-minute time frame again, and we saw a situation where the market is trending, and this happens quite often, so that's why I'm showing this to you. But I'm also going to talk about the challenges related to this approach, so that you can go and study this and incorporate some parts or all of it into your own strategy if you like. But I talked to you earlier about momentum and how there is actually two kinds of trades there's only momentum trade where you try to get into that momentum move, and then the other kind of trade is mean reversion trade, where the market is trading sideways, there's no momentum, and you just buy low and sell high. So now, first of all, we obviously need something that identifies momentum, and here we are using two things. First of all, you have this moving average that is moving below the 50 period moving average. So in this case, this is 10 period. Let's see if I can bring them up. Yeah, this is actually 7 period. It was supposed to be 10. Let me change this. Just a moment. 1, 2, 3, 4. Yeah, there we go. 7 periods to 10. So 10 and 50, fast and slow moving averages. So very simple stuff. We have 10 period moving below 50, indicating that the momentum is to the downside, and also most of the price action is taking place below the 50 period moving average. So that suggests that the price might be moving lower, and it's always just an indication and suggestion. The indicators never know what's going to happen. They just follow the recent price action. And here the recent price action was bullish earlier, but then the moving average crossed below, and now we have bearish price action here. So when this is true, we can take the stochastics and use the signals from stochastics to really pinpoint the entries. So the idea is that when the stochastic is moving higher, it is moving towards overbought area, and then once it rolls over, it is basically signaling that the price is rolling over. So the setup here is that you have the fast SMA below the slow SMA, and you have the blue line crossing over the red line, below the red line. So the stochastics is giving a signal. So here the signal would take place on this candle, and then the price hesitates for a little while and then drops. So that's the short entry mechanism in this trade idea. Then the price moves lower, and then we do have here another crossover, but this is quite low. This is almost at the oversold area. So even though this is still a profitable signal here for a little while, the price quite quickly moves to oversold area, and then starts to move sideways. So not a great signal there. And when you have market moving sideways like this, you might want to take a look at the timestamp. In my time zone, this is usually the Asian session. This is, let me show you. Here, this is where the New York session closes and the Asian session starts. Often very low activity here. So it makes sense to have this as one of the filters. You want to have periods when the market is active. So let's wait until around 9 o'clock, 8:30, and pound USD is starting to move again. And now we have a rally going all the way up to the 50 period, but then it fails and we have another signal there. We have price rolling over, the blue line crossing below the red line. So the values in stochastics are 5, 3 and 3. And now we have another signal here to go short. And then market moves above the 50. So obviously now we really don't have the same setup anymore. And also it's the Asian session again. So not much is happening there. But now we seem to have some bullishness here. But when the European trading starts, there's only a little rally higher and then the market starts to chop again. So not a great time to be trading this. No clear signal because we have slight up move there. We have the 10 period moving average crisscrossing above and below the 50, nothing much happening. And this is yet again during the midnight there. Then the market takes off the next day in the afternoon, just before, in the European time, in the afternoon, just before the US market opens. And we seem to have some momentum to the upside. So now we have the short SMA above the slow SMA, so it makes sense to look for signals in this oscillator, again, stochastics oscillator. And now the challenge is, if the market is really strong, do we go and take these signals here? That is a bit of a problem. Quite often, if the oscillator is overbought already and the market has moved already quite a bit and it's the Asian session starting, so not a great time to be a buyer there. And yes, the price moves sideways, but now we do have this upward tendency here. The 50 period is pointing higher. So in a situation like this, when we have the European session going on and the oscillator is oversold, you might consider taking the long signal. According to this approach, this would be the time to go long there. The market moves against the position a little while. Let's see what happens then. Then we have some up movement and a plateau there when the US session draws to a close. And then the trade is stopped out. So that brings the question, when should you exit? Obviously, if the price rallies just a little bit and then moves sideways, no real action, no desire to take this price higher, and then we start to move below 50, you might want to exit somewhere close to your entry and see if the direction is changing. So there's two approaches really. One is that you find a programmer or you learn to code yourself and create a trading strategy based on these oscillators and moving averages, times, etc. Degrees of momentum, whatever you decide to throw in. But that's very challenging. I find that it is better to have sort of what's it called? I've forgotten the word now, but hybrid. Hybrid is the word I was looking for. So hybrid approach, where you have both the human intelligence and the indicators and you decide based on what you see in the price charts. And then you are better positioned to take the trade or sit on your hands and stay in cash, because that's a trading decision also. So here we have those elements. We have momentum, and we have a pullback, and then market finding its legs again and moving higher. So this helps you, and the pullback. After the pullback, we have the signs of strength here in the oscillator when the blue crosses above the red. So you have all those elements coming together, and one of the options is that you buy when the signal comes, and when the market comes close to the end of the US session, you decide to exit and then wait and see what happens the next day. Then we have the market moving down. Momentum is to the downside, but there's no rally that would take the oscillator into the overbought zone during this period. And then again, we do have momentum to the upside, and the price retraces here. We get an oscillator signal to go long, and we only get a little movement, and then the price just keeps on sideways. So I find that it's good to have a time stop in your strategy. If the market doesn't move and just keeps on fluctuating, then it means that, yeah, the most of the move was already there, and it's not going to move more now. But obviously, there will come a time when a strategy like this catches a big move. And then the market is just going to run and run and run. But then when the market is really strong, you have to make the decision whether you incorporate some other rules into your strategy, where you might be a buyer on these oscillator crosses when the market is breaking out. So it is a tough job, I admit that. But if you do your analysis properly and look at also other time frames, not only this single time frame, then maybe you have a higher time frame, say 2 hours, as your trend time frame, and then this is going to be a signal time frame. But we can get into those nuances in some other videos. So hopefully this helps you to move forward and start learning different ways of building trading strategies. And in the future, we're going to look at price action and how to combine really price action and different oscillators and technical indicators in the future webinars. So thank you for your time. I'm saying trade safe, and I look forward to seeing you soon.